Charitable Giving Through Estate Planning on this edition of WealthWise. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory. I'm glad you joined us today to hear our founder, Chuck Vickery, explain the ins and outs of charitable giving through estate planning. Welcome, Chuck.
Thanks, Deanne. We're talking about strategies for charitable giving, where you get good from doing good as you touch, change, improve, impact, and provide for those institutions you care about. And strategy number 4 is estate planning. Now, there are 4 ways we transfer assets at our death. Number 1 is with beneficiaries. So if you have a retirement plan, it has a beneficiary. If you have an annuity, it has a beneficiary. If you have life insurance, it has a beneficiary. And on your bank and your brokerage accounts, you can put what's called a transfer on death provision on those and essentially add beneficiaries to your banking and brokerage accounts. The second way we transfer assets is through ownership. And there's 2 types of ownership. There's tenants in common and there's joint with right of survivorship. Tenants in common is normally used in business, whereas joint with right of survivorship is for couples. Your checking account, your savings account, your home is probably owned joint with right of survivorship. And at the first death, the survivor instantly owns the asset. The third way is a living revocable trust, where you set up a trust, you name yourself as the trustee and as the beneficiary, and you also name successor trustees and successor beneficiaries. The fourth way we transfer assets is with our will, where we name the people that we want to receive our assets. Many people don't realize that beneficiary designations, ownership, and trust all trump the will. And what goes through the will are things that do not have beneficiary designations, are not jointly owned, or not in a trust. So I mentioned earlier the Secure Act. Made a lot of changes, but two major changes. One was you wait until age 72. The other one was the change for non-spouse beneficiaries of retirement accounts now have to withdraw money within 10 years of receiving it, where they used to could draw it out over their life expectancies. So we want to make sure in our estate planning that we transfer the right asset and that we die with the right asset. So what am I talking about here? So in people's wills, they will often set up a provision to give money to a charity or charities. So what goes through the will? It's not your beneficiary designations, and if you're the first to die, it's not your home or jointly owned property, and your trust doesn't go there. Whenever the Uncle Sam gives you something free, raise your hand and take advantage of it. And one of the things that they give us is called a free step-up in basis. And I'll use your home as an example. If you die and your children inherit your home, they can sell it tomorrow and not pay a penny's capital gains tax on it. Why? Because the basis stepped up from what you paid for it to the current value. But that's also true of stocks, bonds, real estate, other assets. They all step up in value. So we see a lot of clients wanting to leave assets to their church or to their charity, and they put it in their will. And that's fine. But it might be better to do it a different way. What if, rather than naming the charity in your will, you name the charity in your IRA beneficiary? Well, why would I do that? Well, think about it. The charity has to pay no tax on that money. And if you leave the IRA to your children, they have to take that money out over a 10-year period. And if your children are successful, the last thing they want is to have a lot of income coming in that's taxed at a very high rate. So think about it. Would you rather inherit an asset that is taxable or an asset that's tax-free? And your kids want to inherit the tax-free asset as well. So we're not saying exclude the children from your retirement accounts, but if you wish to gift to a charity or charities, do it through your retirement account, through your IRA, and not through your will. Let's leave those assets that are fully taxable, at least some of them, to the charity, and those assets that are fully tax-free to your heirs. We've discussed 4 strategies for making charitable contributions: gifting appreciated assets, utilizing donor-advised funds. Once you're 70 and a half, doing qualified charitable distributions from an IRA. Number 4 is making bequest of taxable assets to the charity of your choice and making sure your tax-free assets go to your family. Now, out of these 4, which are best for you? I don't know, but if you'll come see us, we'll be glad to discuss this with you.